All right, guys. So for the exam, you need to put more effort compared to what you used to do on the test. I know we can all agree with the test that we could just do one revision class and then 80% of the work you find it in the exam, in the test. Right? But with the exam now, they're going to examine everything. Remember, you have 200 marks, so they can examine everything in different versions. So you need to make sure that you work hard and you know your work. Right, let's get into it, right, and see what's going on. So the first part now, it says prepare the consolidated statement of changes in equity, all right, of the Toulouse Limited Group for the year ended 31 August 2021. Only retained earnings column is required. All right, so the one statement of changes in equity, but only the retained earnings column is required. The following line items in the retained earnings columns are required. Opening balance. Look at it. 24 marks. Profit for the year. 25 marks. That's a lot, eh? I'm sure you guys agree with me that that's literally half a paper. All right? And then please note comparative figures are not required. Total columns are not required. Notes to the annual financial statements are not required. Round off amount to the nearest rand. Your answer must comply with IFRS. Let's quickly go there and see now what is happening there. Right, so Toulouse Limited is a company listed on the Johannesburg Stock Exchange. Toulouse manufactures and sells tour buses for the South African transport market. Right, so it's quite important, all right, in regards to this, to note what your company does. All right, so in terms of this, you can see the company now, all right, sells tour buses. All right, so in terms of this, so self tour buses, so which means now, I'm sure you guys agree with me now that buses is their inventory. All right. So whenever you see them selling tour buses, it's important to note that this is actually their inventory. All right. Toulouse and all its investments as 31 August year end. The following extract of the trial balances of the respective companies are presented for the year ended 31 August 2021. So these are the companies that they have. Crancy Wheels. Crancy has proven its ability to stay ahead of his peers due to an innovative and highly competitive management team. On 1st of November 2018, so look at it, it's important. 1st of November 2018, Toulouse acquired 40% interest in the ordinary shares of Crancy for a cash consideration of 1,384,000, thereby exercising significant influence over the financial and operating policy decisions of Crancy from that date. Now, what does it mean? They bought 40% shareholding, all right? And they're exercising significant influence. So we said when you have significant influence, it means that this is a what? Associate. All right. So you guys remember that. So it means this company, when they did the acquisition, is actually an associate. Right. Crank specialized in customer-made bus wheels and tires. Crank's net asset value was considered to be fairly valid at acquisition date, with the exception of the following item. Now, to note, what does this company do? They make custom-made bus wheels and tires. So this is their inventory. So whenever you see the soft bus wheels and tires, it's important to note this is the soft their inventory. All right. Current net asset value was considered to be fairly valued at acquisition date with the exception of the following items. So manufacturing equipment with a carrying amount of 1,850,000 was considered to have a fair value of 2,836,301. The equipment was deemed to have a useful life of 5 years from 1st of November 2018. All right. So that's PPE. Details of the equity of currency at the acquisition date were as follows. Share capital, preference shares, retained earnings. The preference shares are cumulative and non-redeemable and attract an annual preference dividend of 20,000. Right. So something of note. So we have different types of preference shares. All right. We have cumulative. So cumulative, it simply means if a dividend is not declared, all right, it will be paid at a certain point in time. You have to pay it. It grows. All right. In other words, it continues being in your records. You have to pay it at some point in time. Then non-cumulative, of course, if you don't declare dividend, it means it just goes on like that. All right. So basically, that's what we have in regards to cumulative and non-cumulative. All right. Then we proceed. The next one. Preference dividend were last declared and paid on 1st of November 2017. By 31 August 2021, all the outstanding preference share dividends and the current year's preference dividend have been declared and paid by Cransim. Since acquisition, Cransim has been selling bus wheels and tires to Toulouse at a profit of 25% on cost. Included in Toulouse bus wheel and tires inventory balance at 31 August 2021 is 820,490. 2020 it amounted to 980,000 for the period 1st of September 2020 to 31 August 2021. All right, it was 320,000. All right, that's basically what we have in regards to that part. Right, then we proceed. Right, the significant drop in share price occurred as a result of the COVID-19 pandemic when the country went on lockdown. There is no indication when this pandemic will come to an end, and as a result, the viable future of Cransim seemed bleak, as can be seen in the decrease in profit for the year ended 31 August 2020. Therefore, there were an indication during the 2020 that the investment in Crankim may be impaired. In accordance with IS 36, paragraph 12, Toulouse financial advisor estimated that Cranky will pay an annual normal dividend of 200,000 to its shareholder in future. The future dividend are equal to the cash flow available for distribution to shareholder, an appropriate discount rate of 10%. The recoverable amount of the 40% investment in Cranky increased to 1.4 on 31 August 2021 due to the government's effort to stimulate economic growth. 31 August 2021. It was evident that Crank no longer experienced financial difficulties. Right, so in terms of this, I'm sure you guys can see now with regards to this, there's actually an impairment of an associate. Now, guys, when it comes to impairment of associates, this is something that we can agree now that we never touched on when we're preparing for assessments, all right, the test. So this is why I encourage you guys to make sure that when you're preparing for the finals, use the final tutorial letters. You can find comfort, all right, in looking at the prior test, the test that you guys wrote, all right. Remember, there's those tests that you guys wrote. You can have comfort, all right, and cruise through. But the stuff they examine you is what's in these final exam packs. So you need to familiarize yourself with these final exam packs. All right. Right, so then Aloha Tours and Chateaus. Right, during 2017, the directors of Toulouse decided to expand their business. Toulouse acquired 70% of the ordinary shares in Aloha 1st of August 2017, thereby obtaining control of Aloha in accordance with IFRS 10 consolidated financial statement. The retained earnings of Aloha amounted to 950,000 by the acquisition debt. And then the details of the purchase agreement of the interest acquired in Aloha were as follows. A cash payment of 900,000 was made to the transacting attorneys in the trust account on 1st of August 2017. An amount of 200,000 was paid the previous shareholders into of Aloha on 1st of August 2019. So it's important, right, in regards to this, to pay attention to the debts. Look at it. They paid later. See, they paid 200,000. That's like literally more or less like 1 year later, 2 years later. Remember, the transfer took place in 2017. The other payment took place in 2019. So it's important to note, right, there's time value of money to pay attention to. Unfortunately, the examiners, they realize that you guys now, when they give you the interest rate, so assume they'd given us they said pre-tax interest rate. It was more like a hint. So what do? They give it under additional information. So you need to make sure that as you be studying, all right, or as you be writing the exam, your mind is in one piece. Because if you don't pay attention to this debt, you could have missed this amount. This is a deferred payment, all right? You have to net present value, but we'll come back later. The purchaser is liable for legal fees in respect of the drafting of the purchase agreement and the transfer of the shares. These fees amounted to 90,000 and was included in the payment into the trust account. In regards to this, all right, look at it. There's some legal fees, all right, being involved with regards to this part. Remember, I'm sure you guys still remember when you did IFRS 3, What did we say about transaction cost and the legal fees? Sure, you remember we excluded them. So that's that principle. And that except for the item mentioned below, all the other assets and liabilities of Aloha were deemed to be fairly valued at acquisition date. So if inventory, trade receivables, the inventory on hand on 1st of August 2017 was sold during the 2018 financial year, and the trade receivable balance on 1st of August 2017 was written down to net realizable value on 31 August 2018. On 30 January 28, 2019, Toulouse sold an entry-level tour bus for 443,830 to Aloha. Right. So in terms of this, there is a sale of a tour bus over 5 years. That's crucially important. Let's see, what does Aloha do? All right, in regards to this. So in terms of this, we can see now they decided to expand their operations, all right, by purchasing Aloha. All right. And then we're not really told what a law actually does in terms of this. All right. Let's proceed reading and see what's going on. All right. So, Toulouse profit percentage for all entry tour buses is 20% on cost. A lower depreciate the tour bus over 5 years. Now, what is going on in regards to this? All right. You're looking at a situation. Now, it's rare cases, but we're looking at it. So, self-inventory. All right. So, self-inventory. All right. Um, then, um, then the other company is PPE. So, it's inventory in the other company. Then it's PPE in the other company. So, it's one of those cases also that you need to pay attention to. All right, we need to note in regards to this to have better understanding with regards to that. All right, let's proceed now and see what's happening. On 1st of July 2021, Toulouse decided to sell 80% of its 70% investment in Aloha at the prevailing market value on that date. From that date onwards, Toulouse did not exercise control or significant influence over the financial and operating policy decisions of Aloha. Fair value per share of the companies in the group was as follows at the respective dates. So these are the fair values per share that they have. Additional information. It is the accounting policy of Toulouse to account for investment in subsidiaries and associates at cost in terms of IAS 37 in its separate financial statements. It is the accounting policy of the Toulouse Group to account for plant and equipment according to the cost model in terms of IAS 16, property, plant, and equipment. Depreciation is provided on the straight line basis over their estimated useful life. Toulouse has various insignificant equity investments that are accounted for in accordance with IFRS 9 financial instruments. Toulouse irrevocably elected to present any subsequent changes in the fair value of the investment in equity instrument and other comprehensive income and mark-to-market reserve. All right. Unless specifically stated otherwise, all income and expenses are accrued evenly throughout the year for all companies in the group. Toulouse elected to measure non-controlling interest at their proportionate share. Look at it. So NSI is measured a proportionate share of the acquiree's identifiable net asset, the acquisition debt. A market-related pre-tax discount rate of 10% per annum is deemed appropriate. All right, remember you're going to need to discount that part. Then there were no changes in the share capital of any of the entities during the year. Assume South African normal tax rate 27% and capital gains inclusion rate 80%. Ignore the effects of dividend tax, value-added tax. The cost to sell any share in the group is negligible. Ignore the taxation consequences of any possible impairment. Now, you're sitting there, right, with this question. Now, the first thing, guys, that you need is to develop an approach. How are you going to answer this question? All right, that's the first thing now that you need to have at the back of your mind. What is going to be my approach, all right, in regards to this question that we're going to look at, all right? So the correct approach, all right, with regards to this question now, guys, is they want you to do the retained earnings. All right, so the question is saying, do the retained earnings. So statement of changes in equity. statement of changes in equity. All right, so they want, of course, retained earnings. So you have your heading there, right, which says retained earnings, the only one, the retained earnings column. And then, so of course, you have your opening balance, all right, which says they're awarding about 24 marks. All right, I'm not saying you should write this in the exam. And then you have profit for the year, all right, which they're awarding. In regards to this question, there's 25 marks. All right. And then, of course, you have your closing balance. There's no mark for that. All right. But of course, you need that. Now, what is the approach in regards to this? All right. Let's have an understanding before we start attacking this question. Let's recall what are the basic principles that we know. So, here we have holding company. All right. We have associate and subsidiary. These are the three companies that we are dealing with. All right. So for opening balance, all right. So opening balance, guys, we're going to take 100%. All right. For opening balance, we're going to take 100% of the opening balance. All right. 100% retained earnings. Opening balance of holding company. Right? I'm sure you guys remember that. So with regards to the holding company, you're going to take the retained earnings balance, right? 100% for the holding company. Then you, of course, you can deal with intragroup transaction. Let's do that later. And then you come to associate, right? How do you deal with associate? So for opening balance, remember associate, you calculate that amount that equals share of profit of associate. So in regards to this, the share of profit of associate, but we're looking at it from the previous year, not in the current year. Remember, retained earnings, it means we're looking at the profits, accumulated profits from the company, the day the company started trading until to date. So which means now for associate, we are going to take percentage shareholding, right? So retained earnings of associate times percentage shareholding, right? That's how you go about it, right? In regards to that. And then you look at subsidiary. So subsidiary, you also take retained earnings, subsidiary. Remember, with regards to subsidiary, there's a portion of your profit that you allocate to non-controlling interest. So it means now a subsidiary also multiply with percentage shareholding. All right? In regards to this, that's what you include here at group level. Then adjust with intra-group transaction. That is the approach, all right, in terms of this. So that is how we're going to be answering this question. All right, let's get into it, right? Let's deal with one transaction at a time. So let's look at the calculation of opening retained earnings balance. So we're just going to follow information as we go forth. All right, let's start off with Toulouse, all right, which is the holding company. All right, so in terms of this, let's call it working one. So opening retained earnings balance. All right, let's deal with Toulouse. So Toulouse, all right, in regards to this, so we have our company, all right, which we call Toulouse. All right, so let's deal with Toulouse, all right, in regards to this first. So Toulouse, here it is. So in terms of Toulouse, as you guys can see, we're given the opening balance, all right? So this is on 31 August 2020. We are preparing for which year? So they want us to prepare the retained earnings, statement of change in equity, all right, for 31 August 2021. So which means now, in regards to this, they gave us the opening balance, all right? Remember 31 August 2020. It means this is the opening balance for 2021, all right? So we're going to start off with retained earnings for Toulouse, all right? So opening balance, all right? This is given. I did not do any magic there. It's amount that's given. So you have a 2.5 as your starting balance. All right, you record the 2.5, it's given there. Now let's see in terms of Toulouse, right? What is going on now with regards to Toulouse? all right? So in terms of the presented information, all right, is there any intragroup transaction whereby Toulouse is selling? All right, in terms of this, let's quickly see if there's any intragroup transaction. So there's a lower toes, all right, and then that. Let's see, all right. So in terms of this, the board there, all right. Let's see, is there any intragroup transactions taking place? Right here on 30 January 2019. Toulouse sold an entry-level tour bus for 443,832 Aloha. Right. Now, in terms of this, look at it. The sales are happening 30 January 2019, which is in the previous years. All right, it's not in the current year. Remember, the opening balance of retained earnings is the balance that's coming from the previous years. All right, so that means now, in regards to this, since Toulouse is the one that's selling, all right, it means now this transaction it does affect the opening retained earnings balance. It's crucial that we always remember that. All right. So let's look at it, all right, in terms of this, to have better understanding in regards to this. All right. So we can see Toulouse now is selling, all right, they're selling. Toulouse sold an entry level tour bus for 443,832 Aloha. Toulouse profit percentage for all entry level tour buses is 20%, and Aloha depreciate the tour bus over 5 years. Right. I want to break this transaction. I know, of course, we rarely see transaction where there's a self-inventory, right? And then on the other end is PPE. So I'm going to show you how the journal entry looks like before we start answering this question, all right? Let's first look at it, all right? So that just in case the examiner decides to examine otherwise, all right? So journal entry on self-inventory, all right? Which is PPE, another entity. All right, so they're selling inventory, which is sitting in it as PPE. Right, so in terms of this, in the books of the seller, all right, in the books of seller, which is Toulouse, we need to eliminate. Remember, Toulouse is going to say we made sales of 443,830. So we're going to debit sales or revenue. So we debit sales, we eliminate it. All right. So we are going to debit sales, all right, with the full amount, which is sitting at 443,830. All right. All right. On the year of sale, this is the intra-group transaction that we do. Then we credit cost of sales, P&L. Now, what's going on with regards to cost of sales? We want to eliminate, remember, in regards to this sale, right? We're saying, no, this sale never took place. So we said, no, but how much did you purchase was the original cost of this bus? All right. So we told now that Toulouse, all right, they make a profit of 20% on cost. All right. So in regards to this, remember, we said now, in regards to this calculation, so 20% is on cost, which means now cost is equal to 100%. Remember, we said whatever they're using to calculate their markup or the profit. So if they say 20% on selling price, it means selling price is 100%. They say 20% on cost, it means cost is 100%. So which means now, all right, in regards to this, so if cost is 100%, how much is selling price? Selling price is going to be 100% plus 20%, which is going to give us 120%. That's what we have in regards to this. So the 443, we can see 443,830 is equal to, this is the price they sold for. So this is the selling price, all right? Which means this is 120%. We want to determine, in terms of this, how much is the cost. So the cost is going to be less. So which means it's 100 over 120 times 443,830. All right. This you need to know. All right. When they say it's on this, you should be in position to determine how you're going to go about in terms of your calculations. All right. So you go about it like this, all right, and then it will give you, of course, your calculation there. So it's important, all right? And then, of course, now this is something different. You then credit in regards to this. Remember, the unrealized profit is going to be sitting in property, plant, and equipment. All right, so you then credit property, plant, and equipment, which is SFP. So which is 20 over 120 times 443, 830. All right, that's how you can go about it in regards to that part of the question there. So you go about it like this. All right. That is how you can do the calculation. So your calculation will be sitting in like this. All right. That's what you have on the date of sale. Then, of course, since they're providing excess depreciation on this amount, you then provide a journal in regards to that depreciation as well. So you debit, of course, in regards to this, you debit accumulated depreciation, you credit depreciation. Then here you also do a journal for deferred tax. All right. You can see on the P&L legs, all right, there's P&L 443 and P&L 36, all right, which means now the income is decreasing, the expenses are increasing, but there's a difference of 73. So which means in regards to this, income tax is decreasing. So you do a journal, you debit deferred tax, SFP, you credit income tax, P&L, all right, in regards to this. So with the 73972 times 27%, which is your tax rate there. Right, so that's how your journal would line up, all right, in regards to this transaction. Of course, like I said, it's something that we rarely see every day, but these type of journals are possible. So should it happen that they give a scenario whereby it's inventory in the other books, all right, and then it's PPE on the other books, that's the journal that you need to process. Then you do accumulated depreciation, all right, SFP, that was not required, all right. I'm sorry for showing you this, all right, just in case. You help us as well when we're working on this question. All right. So you take 73972 divided by, in regards to this, it was 5. Then you multiply by, of course, the point of sale. So the sale took place on 1st of August 2017. Oh, sorry, 30 Jan 2019. So if you were to prepare the journal for 2019, we have February, March, April, May, June, July, August. So that's like 7 months. So you can say times 7 out of 12. Right, so that's the journal which they could have processed during this period. Then you do a journal for P&L and all that. All right, I hope I'm making sense there. Now let's now get into answering this question. All right, sometimes it's important to do this. What happened? So we have 73972, 73972 divided by 5. All right, so it then becomes like that. Right. Now let's answer our question, right, so that we can have more sense. I was just showing you this. Now, we have the profit, all right, it's sitting in like that, all right, so which means now, in regards to the transaction that transpired, all right, between this sale, all right, as you guys can see, there's a sale that took place here, which means now in 2019, Toulouse recorded a profit on this sale. As you saw on that journal entry that we processed there, they're recording a profit. All right. But now this profit now, we need to eliminate it. All right. We need to remove it from our accounting records. I'm sure you guys saw in terms of this, all right, the sale was this. They recorded the sale of this, and then the cost of sales was this. So which means now the difference between these two is the unrealized profit, which is 73972. All right. In the following year, so in the following year now, we won't have cost of sales and all that. Remember these amounts, the P&L will move them to retained earnings. So we debit retained earnings, we debit deferred tax, then we credit property, plant, and equipment. So which means we're going to have unrealized profit, all right, in terms of this deal. All right, so in an exam, of course, you're not required to be showing those journals. You'll be wasting lots of time. So it's important that you process it at the back of your head. So you have 443, 830. All right, so you have 443, 830 times So we said 20 over 120. This is what will give us the profit, but we want the profit after tax. So we multiply with 73%. So that's what we have now is our unrealized profit. So we're going to come here and eliminate, all right? We remove it from our accounting records. We say, no, we recorded too much profit. All right, there's an element of unrealized profit which you're supposed to remove from your accounting record. So you remove it like that. All right. And then now on this transaction, remember we spoke about Aloha going to be providing depreciation over a period of 5 years. But now Aloha is going to be providing too much depreciation. All right, in regards to this. So we need to reverse the too much depreciation which they are providing. So in regards to this, all right, so we're going to have unrealized depreciation. All right, in regards to this part, unrealized depreciation. The part for unrealized depreciation will be a bit tricky in terms of this. So you need to calculate depreciation for 2019, 2020. All right. Those are the parts now which were crucial because remember, you're preparing the opening balance of retained earnings for those years. So you have to calculate now and realize depreciation for those years. All right. Remember, this is depreciation they were providing in the prior years. Right. Before I do this, can you guys visualize this? Or you want me to do the journals? Do you visualize what I'm saying, guys?
Can you please do the
Please do
journals?
the journal.
Okay, but in an exam, you won't have time to process journal. I'm just doing the journals to show you what's happening. But in an exam, if they ask you for that, you can't do the journals, otherwise you won't finish. All right? Remember, in regards to this, you have done this. This is a journal which they're going to process in 2019. All right? This is 2019 journal, which means now in 2020, how is this journal going to move? Remember, all P&L amounts are moved to retained earnings. All right. So which means now in 2019, this journal is going to convert. So they're going to have accumulated depreciation like this, SFP. Then the credit retained earnings, SFP. Then they have deferred tax, SFP. So the accumulated depreciation is going to stand at 8630. All right. And then retained earnings, you have 8630 times 73%. Remember, 73 is coming from 100 minus 27%. So you have 8630 times 27%. And then deferred tax will be 8630 times 27%. So that's what we have in regards to, or what did I do here? Right, so that's how your journals will line up as, right? Crucially that you pay attention. This is in 2020. Then in 2020, they provided journal, accumulated depreciation, right? SFP. Remember, they're providing depreciation on this equipment. So they're going to have depreciation, which is 73972 divided by 5. Here they have the asset for the whole year. They're not going to prorate the depreciation. All right? So they'll be sitting in like this. So that's the journal which they're going to process in 2020. All right? And then they have deferred tax. As you guys can see, so they have income tax, P&L. Remember, depreciation is a P&L, which is on the credit. That means income is increasing. Then they have deferred tax, SFP. So with 14,794 times 27%. So this is what they're going to process in 2020. Right, so their journal are going to line up like this. Now, in 2021, all right, this same journal, what are they going to do? So in 2021, they're going to have retained earnings. Oh, sorry, they're going to have accumulated depreciation. Right? But the accumulated depreciation now is going to be made up of what? So it's going to be made up of this depreciation, 14794, plus the accumulated depreciation for 2019, which is the 8630. All right? So that's what we give you the total accumulated depreciation. So it's going to be sitting in like this. All right. And then you credit retained earnings. This is opening balance. SFP with 23,424 times 73% to make it after tax. All right. And then you have deferred tax. SFP. So the deferred tax, of course, it will be the 23,424 times 27%. So it'll be sitting in like this. All right. Then in your statement, all right, in your calculation, this amount is now, remember, it's opening return earnings. That's the amount that you're going to record here as unrealized depreciation. Are you guys with me there? Right.
Yes.
All right. Alternatively, how you could go about it, all right? Remember, like we said, you don't have all the time, all right, to be doing this. So what you can do in terms of your opening return earnings, what you can do, you can just quickly say, how many months are there, all right, from 30 Jan 2019 up until 31 August 2020. How many months are there? So you can count. So Jan to August, we said there's 7 months. All right. And then in 2020, there's 12 months. So 7 plus 12, it gives us 19, right? So what you could do, you can just take 443, 813. So you can take 443, 830 times. So in regards, so sum 20 over 120. All right. That's the unrealized profit. Then you divide by 5 times. So your accumulated depreciation is over a period of 19. So 19 divided by, remember, 5 years is 60 months. 5 by 12 would give us 60. So you can divide by 60. Then you say times 73%. All right? That's an alternative or a quicker way you could go about it. So it takes this one. It takes lots of practice now. If you have no understanding in regards to this, all right, you can just quickly do it like that. All right, let's see if it tallies 3420. Oh, sorry, we're not supposed to say divided by 5 since we're using that. All right. Remember the 5, we converted it into months. So this one takes a little bit of practice there. All right. So if you've mastered your things, you can go it like that. All right. So you're done with Toulouse. All right. You move on to another company. All right. You're calculating opening returned earnings. So which other company do you have there? All right. So you can look at it in terms of this. You have in terms of this, all right, you can do, okay, let's do Aloha, all right, then Cranes will do it last. So Aloha is a subsidiary, all right, so Aloha, all right, subsidiary. All right, so for subsidiary, we're going to do the same calculation. We're going to need now the retained earnings of Aloha. So now, opening balance. I'm sure you guys know how to calculate the opening balance of a subsidiary. We need the retained earnings from the date we acquired the subsidiary until to date. Remember from your analysis of owner's equity that you guys have been doing since undergrad. So here you have 2595. That's the retained earnings on 31 August 2020. So you have 2595. All right, then you minus the retained earnings on acquisition debt. Remember, you're not yet the owners, so you need to deduct the retained earnings on that debt. So let's see, in terms of Aloha, what is the retained earnings? All right, so Aloha on the acquisition debt, they had retained earnings of 950. All right, so we have 950. Then we say you multiply with your percentage shareholding in this company. So how much interest do you have? You have 70% interest. So you multiply with your 70% interest. So that's what you have. All right, in terms of your opening balance of Aloha. All right, so Aloha, the opening balance of Aloha is that. Then you do, is there any intra-group transaction? All right, all right, for Aloha. Let's quickly see if there's any form of intra-group transactions. All right, so when they acquired Aloha, all right, in terms of this, you've been told, except for the item mentioned below, the other assets and liabilities of Aloha were deemed to be fairly valued at acquisition debt. Now, So on acquisition debt, the carrying amounts of these items were different to the fair values. Now, I want you guys to note something, all right, in regards to this principle. Okay, let's write it at the bottom, all right? In acquisition debt, all right, I want you guys to note, so in regards to this, if carrying amount of assets, of current assets and current liabilities are different fair value, all right? The difference is transferred to retained earnings. All right. So for current assets and current liabilities, if the carrying amount and the fair value is different, the difference will transfer to retained earnings. Then if carrying amount of non-current assets, all right, current assets is different to fair value, the difference is transferred now to revaluation surplus or mark-to-market reserve in case of shares. All right. I'm sure you guys is making sense in regards to this. I believe when you did IFRS 3, all right, you notice that you have to realize the revaluation surplus. All right. It applies when you have non-current assets. Then when you have current assets, the difference between the fair value and the carrying amount will transfer it to retained earnings. So look at this scenario. All right, you're gonna note that there's a difference between the carrying amount of inventory and the fair value. As well as the trade receivables, you can see there's some differences. What is the journal that you process? Look at it. Inventory sitting at 56, and then the fair value is 69. So which journal do you guys process? All right, in regards to this. Remember, on the on acquisition debt, you're going to debit inventory. Right? Then you credit retained earnings. I'm sure you guys remember that journal, right? You process it like that, all right? And then later on, what do you then do? In regards to this, since the inventory is sold, look at it, the inventory on hand was sold in 2018. So this inventory has been sold. So what do you do when you sell this inventory? You reverse that journal, which means now you're going to debit retained earnings. All right. So you debit retained earnings in terms of this journal. So you are reversing to say, no, the sale has taken place. I'm reversing the retained earnings that I recognize on or the acquisition debt. I don't know if you guys still recall that journal, but that's the logic behind this. So which means now, all right, in the opening retained earnings balance, all right, you have a journal which you have reversed now the retained earnings. So you have now, in regards to this, you have an inventory. Right, on the acquisition debt, which is going to be the difference between 69808 minus, so if 69808 minus 56,000, right, times what? 73%, you want it after tax, then times your percentage, which is 70%. I don't know if I'm making sense in regards to this. Are we good, guys, or we lost each other somewhere?
Still good.
Right.
Still good, yeah.
All right, cool. And then, so you do the same. Trade receivables, what's happening? Your trade receivables are decreased on acquisition debt, which means now what is the journal that you process on acquisition debt? You debited, all right? You debited retained earnings. Then you credited trade receivables because it's decreasing, all right? Then, in the following year, what do you do? Remember the trade receivables you're told now they were written down to its net layers of value in 2018, which means you have to reverse that journal. So you're going to credit trade receivables and then you're going to debit trade receivables, then you credit retained earnings. So that means your journal now, all right? So you have your trade receivables. In terms of this, right, the journal that you're going to process, You have 101,698 minus 80,000, right? Times 73% times 70%. So that's how you account for this draw now. But here, since the retained earnings is on the credit, you're going to add it like this. So that's how you go about it, right? Something that, of course, we don't experience that integration when we're preparing for those tests. So it's important, work on the final question bank. Don't have comfort in those question bank 1, 2, 3, and all those kind of things. Work on the final question bank. Right. So that's how we go about it. Right. Anything else? I think that's all right with regards to our subsidiary there. This one we've already accounted for. And then, of course, this one, there's a sell. Decide to sell 80%. Remember, it's taking place in the current year. So it's not going to affect our opening retained earnings balance. Then we move on to the subsidiary, Cranes Wheels. All right, let's quick account for Cranes Wheels now. All right, in regards to this, to see what's going on. So Cranes Wheels, we've said it's an associate. All right, so account for the associate. How do you do now with the associate? The rest, of course, with regards to the associate, we're going to need now, in terms of this, we're going to need the profit, of course, that's coming from the acquisition from the current year, the opening profit that they have, of course, at the beginning of the year. So let's quickly see, all right, in terms of currency, what is happening there. So currency, all right, as you guys can see now, all right, currency is, of course, opening returned earnings of 2210, all right, in terms of this. So for currency now, we have opening returned earnings of 2210, all right, let's account for it. So currency, all right, opening balance. All right, so for currency, the opening balance is sitting at how much? So you can see we have 2210. Right, 2210. So we minus, right? In terms of our retained earnings, we have to, of course, minus now the retained earnings that currency had, of course, on the day that we acquired them. Right, so on the day that we acquired currency, let's quickly see now how much was currency's retained earnings. All right, so you have 2210. All right, and then on acquisition debt, let's see. So the currency, when they acquired currency, they had retained earnings of 3160. So minus 3160. Do you guys see the retained earnings of currency went down? All right, in terms of this, then we multiply with the percentage shareholding. All right, how much is the percentage shareholding that we hold? The 40% interest in currency. So we multiply with 40%. So it looks like currency now made a loss actually. All right, they're making a loss from this point. Right, you see the retained earnings balance has gone down from 3,160,000 to 2,210,000. So that means they're actually making losses. All right, so it's going to be negative. All right, so you have 380,000. All right, in terms of this, that's the profit that we have coming from currency. All right, and then we account for the other aspects. All right, in terms of this, currency specialize in this and all that. All right, and then currency's net asset value is considered to be fairly valid acquisition debt with the exception of the following items. So we have some items now which are being told now that their carrying amounts are actually different to the fair value. So manufacturing equipment with a carrying amount of 1850 is considered to have a fair value of this amount. So in terms of this, we also need to, right, remember, with regards to this, now we're looking at the reserve, right, for currency. So manufacturing equipment with a carrying amount of 1850, but the revaluation, remember in terms of this, the revaluation on this manufacturing equipment, it goes to revaluation surplus. It's not going to go through profit and loss. I'm sure you guys, you remember what we spoke about earlier on, right? That manufacturing equipment is non-current asset. The difference in fair values, it goes to revaluation surplus. But however, in regards to this, on the manufacturing equipment, it's going to affect the depreciation. Right, so in regards to this, so it means now, in terms of this, they were providing now too little depreciation. So we need to increase the depreciation on the manufacturing equipment. All right. So in terms of this, that's the part that we need to, is going to affect our calculation there. All right. So how are we going to go about it? All right. In terms of this part, let's quickly see now how best we can go about it. All right. So, with regards to this, they're providing too much depreciation, which means our share of profit is going to be affected in terms of currency. So the depreciation now, you're going to take the difference. Let's take 28, right? So unrealized depreciation, right, for currency. So the unrealized depreciation, we're going to take now the difference between 2,836,301, right, minus what? Minus 1,850, right? Then, now we're going to divide now by how much depreciation did they provide. So from the debt they acquired, if you look at it, they acquired from 1st of November 2018. So we want to determine how much depreciation is there from November 2018 until 31 August 2020. So November, December, January, February, March, April, May, June, July, August. There's like 10 months. So in other words, 10 months in 2019 plus 12 months in 2020. So it gives us how much? Is it 22 months? 22, right? So as we can take 22, then we divide by 5 times 12, give us 16. Right? So which means the accumulated depreciation that they have is going to be 22 over 16. Right? Then we need after tax, of course, times 73%. I don't know if there's anyone who's lost there. Anyone lost, guys? Are you guys sure you're following?
I am.
Yeah,
Right?
and we are.
Others, are we good?
Following.
All right, fantastic.
They're following.
All right, good. So that means now the unrealized profit, all right, is sitting like that. All right. And then what else do we have under this company? So we have it there, we're done then, all right? So currency. So now we've been told currency now, they have cumulative dividends, right? Currency of cumulative dividends. So we need to check now in terms of the cumulative dividends, what's going on there, right, with regards to currency. So the cumulative dividends now that we're entitled to, all right? Yes, we multiply with 40%. We didn't. Oh, thank you, Miss Ayanda. Yes, we do. Thank you, ma'am. All right, actually, let's skip that part. Thank you. So be careful there. It's actually easy to forget that multiplication. So make sure you know it as well, right? All right, so you do that. All right, that's currency. And then, so after this, we're going to have now, in terms of this, all right, there's a preference dividend. Let's see what's happening in terms of the preference dividend. So we have now, in terms of this, all right, currency. When did they acquire the preference shares? All right, does currency have preference shares? So do you see preference dividend declared in currency? Let's see what is happening, all right, in terms of this. So on 1st of November 2018, the preference shares are cumulative and attract an annual preference dividend of 20,000. The preference shares are correctly classified as equity as the payment of the preference dividend at the discretion of currency. Preference dividends were last declared and paid on 1st of November 2017. All right, so they lastly paid a preference dividend in 2017. But 31 August 2021, all the outstanding preference share dividend and the current year preference dividend have been declared and paid by currency. All right, so in terms of this, we're looking at a situation where currency now is paying a preference dividend. So let's see how much was the preference dividend, all right, that's been outstanding, all right, in 2020. So in terms of this, you can account for preference dividend, all right, that is for 2020, because so it's 20,000 times 40%. right? Remember, dividends are exempt from taxation. I'm sure you guys remember that. So you have 20,000 times 40%. Right, we take you there, all right? That's that part. Now, in terms of subsidiary, so associate, you need to also assess, all right? Remember, there's that gain on bargain purchase. All right, I'm sure you guys remembered from associates, some subsidiaries, all right, from subsidiaries. On the acquisition debt, an associate, all right, you could pay less than the value of the associate, giving you a gain on bargain purchase, all right? But we use the word excess, all right, with regards to associates. So I need now to do the calculation of that amount and see if there is possibility of that excess there. Remember now the acquisition took place in the prior years, which means that excess now will be recorded now in the we record it in the statement of in the retained earnings column. All right, so let's quickly determine in regards to that calculation if there's something like that. All right, workings or associate. All right, so we can call this maybe calculation 3 or 2. All right, so at acquisition debt, what was the value of our associate? All right, so you can see when they acquired currency, there was share capital, preference shares, and retained. You can use analysis of owner's equity, but of course, it's a long process. All right, I don't prefer using that method because it consumes a little bit of time. All right, but if that's the method you're comfortable with, of course, you can go ahead and use that method, but it consumes a little bit of time. All right, so in terms of this, we can just take the acquisition debt, there was share capital of 300,000, right? So we have share capital, 300,000, all right? Then you have your retained earnings, right, on the acquisition debt. So the retained earnings is 250,000, all right? And then after that, you have preference shares. So the preference shares are sitting in it. So the preference shares sitting at, is it 250? 250 is for this one. And then retained earnings is 3160. Right, so we have it there, all right, and then, of course, that's what we have, all right, on the acquisition debt. This is equity now, so you said no, in terms of this, all right, that's what we have as our equity, but we also have revaluation surplus in terms of manufacturing equipment. So manufacturing equipment, remember the fair value is different to carrying amount. So we took, in regards to this, we took 236,301 minus 1850, right, times. So then multiply, of course, we need after tax amount. So we're just going to say times 73%, all right? Then it gives us, of course, our balance there on the acquisition debt. All right, so we have our balance sitting in like that. All right, and then so we have the 720. All right, I think that's what we have as our net assets, right? So we have the net assets sitting in like that on the acquisition debt. All right, so on they did the acquisition on 1st of November 2018, right? That's the calculation that transpired. And then in regards to this, right, they also owing, remember in terms of this, something of course that you don't see every day, but they told us now that the preference dividend was last declared and paid on 1st of November 2017, right? Which means now the dividend for 2018 was owing, right, on this debt. So they were owing. Remember, they're paying the dividend, of course, they're paying the dividend on 31 August, all right? So by 31 August, all right, they're paying the dividend. So which means now the dividend for 2018 was outstanding at this period. So it's a trade payable, all right? So in other words, dividend payable, all right? So that it was just an exempt technique. So they were owing 20,000, all right, as a dividend. So which means this is the net asset value, all right, of our associate before we multiply with our 40% interest. right? A little bit of exam technique was required there. It wasn't really that straightforward, all right? It required a little bit of exam technique there, right? And then after that, all right, we then proceed to the next part, all right? Right, so we have dealt with all that. So the next thing that we need to do now is to assess now, what else do we have? How much did we pay, right, to acquire this interest? So we told you now they paid 40%. Oh, actually, it's in ordinary shares, which means this preference shares needs to go. Sorry about that. All right. So they acquired the ordinary shares, not the preference shares. So they paid how much for 40% interest? All right. They paid how much? They paid there. So let's see 40% interest. That's what they bought. All right. So which means they bought 40% of 4160. Right? This amount gives them the then consideration paid. Right, let's see how much did they pay. So they paid now, all right, in terms of this deal, they paid, how much did they pay? They paid, all right, 1384. 1384. All right, so in terms of this, they paid more than the value of the business. All right. All right, I'll be okay, so Amanda is saying she missed the 20,000. Remember the 20,000 you said that is the dividend. Actually, it's not dividend, but rather it's a payable. Remember when we were calculating net assets, we said assets minus liabilities, which is the same as saying equity. All right, so here we have our equity. All right, then we have, of course, the adjustments of the assets, which is revaluation. Then we have a payable, which was not included there. So it's 20,000 there. All right. So in terms of this now, can you see? All right, they paid this much. All right, they paid 1,384,000 per business, per business worth 1,064,000, which means there's an excess amount which you can call gain on bargain purchase. All right, so excess now is going to be the difference, 664 minus 1384. Please, guys, work hard. All right, I'm sure you can see it's now high level now. All right, so there's an excess of 280,000. So this 280,000, of course, is going to affect our calculation of retained earnings, the opening retained earnings balance. All right, we're going to add it to the retained earnings amount. All right, so when you do the workings, all right, in regards to this, so excess on acquisition. All right, we did it on 2. All right, the 280,000. Right, so that's what we have. But anyways, I'm just going to show you. I want to split. I want to do the split. I'll need this amount somewhere. So I'm just going to do a split like this. All right. So this is the retained earnings, which they have there. All right. I might need it. Somewhere. All right. So we have, so in regards to this, all right, since in terms of this calculation, so we're just going to adjust now with these balances. All right, so we have this, we've calculated that, all right? And then let's see if there's anything as well. There was some impairment which transpired in terms of our, of course, in terms of our associate. Right? Since acquisition, Crank has been, the significant drop. Okay, we can deal with this one first. All right. In terms of this transaction. We can deal with this transaction. There's intra-group transactions that are taking place as well. All right, we can evaluate in terms of this. All right, so being told now, since the acquisition date, Crank has been selling bus wheels and tires to Toulouse at a profit of 25% of cost. So they're selling inventory to inventory, all right, including Toulouse bus wheels and tire inventory balance on 31 August 2021 is 828,490. This one, we don't worry about it because it's current year. We're worried about what transpired in the previous year. Remember, with regards to closing inventory, all right? Remember, you have in terms of this, you're going to have the closing inventory now being affected. by this intragroup sale, which also affect retained earnings since it's from the previous year. So they sold inventory to each other of 118,355, closing inventory, right? But they're making a profit of 25% on cost. So there's unrealized profit in closing inventory. Let's include it maybe somewhere here, all right? So unrealized profit, closing inventory. All right, so the closing inventory now for actually not closing, but rather opening. Remember, this is opening for 2021. So opening inventory. All right, so you're gonna take, in terms of this, we're going to take now 118,355 times. So they're making a profit. So in terms of this deal, there's a profit of 25% on cost, but this amount is selling price. So you have 25 over 125. I hope you guys remember how we came up with the 125 and all that. All right, if not, you can just look at how we calculated that unrealized profit for the other transaction there. All right, so there is unrealized profit, all right, in terms of this. So it's sitting at this amount, right, the 17. So which means now our total balance, all right, in terms of this deal, is sitting at this balance there. All right, that's how we can account for it, all right? In regards to, of course, in regards to this part of the question, all right? Then, of course, remember we said we multiply with 40% on everything, all right? Then you say times 40%, all right? Then it gives us this balance. Any questions for me before I proceed, guys? Let's see, who's here? Just quickly checking who made it to the final exam. Okay, wonderful.
Yeah.
Yes, sir.
On the calculation where we're doing the dividend payable,
Mm.
I was a bit confused that we put 20,000. Isn't it supposed to be accumulating amount since they're saying the last dividend was paid in 2017? Why did we only take for 1 year?
Okay.
Yeah.
So we're doing this calculation for which year? So we're doing for 2019, right?
Are we doing for 2019 or 2021?
No. Remember, we're looking at it from we're looking for anything that happens before 2021, right? That's what we're looking for.
Oh, okay. So that would be 2019 to 2020
Yes, sir.
for the opening balances.
Yes,
Okay,
yes, yeah, for that part.
Mhm.
So basically, that's the period. Remember, in regards to this, they obtained control. It's literally they obtained control in 2019 period. Remember, it's 1st of August 2017. That's when they obtained control. All right, but we can agree we are not entitled to the dividend for this period. All right. So
Yeah,
literally
yeah.
now the period, yeah. So in terms of this, that's why we're just using for that other period there. All right.
Oh, the 18 to 19. Oh, okay. Yeah, I
Yes.
get it.
All
All right,
right.
thank you.
Cool. So basically, that's what we have. So the opening balance, all right, let's deal with the impairment. So you have a little bit of understanding of what happened now in terms of impairment. So we've been told now that the value of our investment actually went down. All right, we've been told that there was a significant drop in the share price, all right, and then the indications of impairment due to COVID-19 and all that. So in terms of this, they estimated, all right, in terms of this, they estimated that they're going to be paying a share dividend of 200,000 in the future, all right, and then an appropriate discount rate of 10%, all right, the recoverable amount of the 40% investment increased to 1.4. Now, you have never done this, but we can agree now that you did impairment loss. How do you calculate impairment loss? Remember impairment, we said impairment is equal to carrying amount minus recoverable amount. That's what gives us impairment, right? So, calculation of impairment. Loss. In terms of IAS 36, all right? You said payment is equal to carrying amount minus recoverable amount. That's what gives you impairment loss. Now, which means now you're going to need carrying amount. All right. Alternatively, if you're smart, you know what smart students will do? Let me get easy marks first. The calculation of carrying amount is hectic. It's long. So what is the easiest calculation? Let me first calculate recoverable amount. Right? You calculate recoverable amount, higher of what? Value in use. So you calculate what is your value in use in regards to this. So you determine what is the value in use. So in terms of the, they gave you to say, all right, let's see how much is our value in use now. Right? So in terms of this, so the value in use that we have now, so they expect to receive a dividend of 200,000, all right? And then I think that's basically what we have there, all right? They're just expecting a dividend. So that's the amount they're expecting to receive. Until when your management accounting principles comes into effect. They're going to receive the dividend, all right, until infinity. Look at it. All right, this question was a bit tricky, guys, if I can be honest with you. Look, Toulouse financial advisor estimated that the currency will pay an annual dividend of 200,000 in future. All right, the future dividend are equal to the cash flows available for distribution to shareholders. All right, until when? You don't know. Until forever. There's a perpetuity. It's tricky, right? You go to IS36, of course, you can look into it. But in terms of this now, you can't use the term value of money principle, right? Where you work, you have to calculate the present value of this. You can't, right? Why? Because with regards to this, you don't have an N. So the only thing that you can do, right, to calculate the present value, you're going to take the dividend, right, divided by interest or the discount factor. I'm sure you've done this in your MAC, a little bit of integration. So it means now your dividend is 200,000, but you're entitled to 40% of this dividend. Then you divide by, of course, your interest rate. You're being told now that the interest rate is 10%. So you divide by 10%, all right? So that's, I believe you guys learned something new today. Careful with the exam. Like I've been saying throughout this session, it's crucial. So it means now the value in use calculation is going to come to this balance. We have 800,000. Then we calculate fair value less cost to sell. Right? Remember, said recoverable amount is higher of these two. So fair value less cost to sell. Let's quickly see how much can we sell this investment. Right? So in terms of this, the recoverable amount increased to this. Right? Let's see what is the fair value less cost to sell. Right. Therefore, there is an indication of impairment. They'll pay to the future dividends. The amount of the profit discount rate is 10%. Then are we given the fair value less cost to sell? The recoverable amount. I don't think we have anything there. Let's just quickly see. I remember seeing the trading price of the shares. Let's see. We'll just work with that, right? Right, look how tricky it was. I think the examiners sometimes they can be a little bit tricky. Look at it. The fair value per share of the companies in the group are as follows. All right, so here they're trying to trick us. They're giving out the share value, 31 August 2020. Remember, we're calculating impairment on this debt, 31 August 2020. It's 33 Rand. All right, of course, we don't have selling cost. So we're going to take 33 Rand times the number of shares that the company has. So how many shares do they have? So we're sitting now with, in regards to our company, we can see now that Crank has 50,000 shares, all right? So these 50,000 shares, we're only entitled to 40% of them, all right? So we have 50,000 times 40%. So that's what's going to give us the fair value less cost to sell, since we're not told about the selling cost, all right? So then take us to this amount, all right? So which means now, remember, recoverable amount, we say a high of the two. So the recoverable amount is 800,000, all right? So 800,000 is our recoverable amount. Then you calculate carrying amount of the So calculate the carrying amount of the associate, all right, on 31 August 20, is it 2020? I think it's 2020, right? So 31 August 2020, all right, what is the carrying amount of this associate? So we calculated the carrying amount at acquisition date. All right, we have already done this calculation of the carrying amount of our associate on the acquisition date, where we took those retained earnings. I'm sure you guys still remember how we took those retained earnings and all that. All right, let's see. Remember how we did the calculation we got in terms of this. We have 166. All right, remember after the 40%, we have 166. So it's coming from working 2. All right, so we have 1664. All right, so that's what will give us the carrying amount on acquisition debt, 1664000. Right, that's the carrying amount that we have. So the acquisition took place. If you note, the acquisition took place in 2018, right, which is literally 2019. Right, so once, which means now, since it's an associate, so the value of the associate now is going to increase with the profits. Right, in terms of this, you're going to need now the profit of the associate from acquisition debt up until, of course, up until the beginning of the current year. So share of profit or retained earnings, all right, in acquisition, retained earnings until 31 August 2020. We did calculate this one as well. If you notice, when we're doing the calculation there, where is it? I think it's at the somewhere. It's up there. All right. Remember, we did calculate the WENSI, the retained earnings, right? It gave us this amount. So we're going to include it there, the 500,512. Remember, associate, all right? Associates increase with profits, all right? So we have 500,112, all right? So 500,112, that's the profit. So it's not to not associates, guys, increase with profit and reduce with dividend. Right, since we've already accounted for the profit and dividend in this amount, so it's just going to give us this. So that means now this is the carrying amount of our associate on this debt. Right, so we have carrying amount sitting like that. Right, and then recoverable amount. Say the recoverable amount is 800,000. Right, that means now, right, we have to calculate the impairment loss, right, in terms of this. So the impairment loss now is going to be, of course, the difference between those two amounts there. Right. So I forgot this one is negative. So the 500 is a loss. Remember, we spoke about this. We said it's a loss. So that means the impairment loss, right, is going to be this amount. So that's the amount now which the associate is going to make, right, as their impairment loss. So this is impairment loss at group level, right? So the impairment loss at group level, right, is sitting at this amount, right? But the associate in its separate books is also going to calculate its impairment loss, right? So you're going to have the associate in the separate books, right? And the associate in its separate books is going to calculate the impairment loss. Group level, so impairment loss in separate books. So in other words, in the books of the associate, they're going to calculate the impairment loss as well. But the difference now is only with regards to the carrying amount. So the associate in its separate books, right, they're going to say, what is the carrying amount, right, in regards to this? What is going to be our carrying amount in terms of their source set. So the carrying amount they're going to have now in their separate books, right, is just going to be the amount they paid for. So they're going to take in terms of this, how much did we pay? So they're going to take, no, we paid 1,384,000, right, to acquire their source set. So they're going to record now as this the carrying amount. All right. So in terms of this amount paid, in its separate books, that's what they have. And then recoverable amount. In terms of this, the recoverable amount does not change. It remained at 800,000, which means now the impairment loss in separate books now is going to be this balance. All right. So we're sitting now with impairment loss, which is sitting at this balance. All right. Then on our retained earnings account, all right, we're just going to, of course, we need to adjust accordingly. All right. So in terms of this, we need to reverse. Where is that calculation? Opening retained earnings. All right. So we have impairment loss, group level. Right. Remember, the impairment loss is from previous years, which means it was moved now to retained earnings. So impairment loss at group level, to rename this calculation, it's calculation 3. Right. Impairment loss at group level is 363,488. All right. So we have 363,488. We have it as a minus 363,488. And then impairment loss, separate books. Reverse. All right, so the impairment loss in the separate books, we're going to reverse, so it will be a positive amount. So in the separate books, we're going to have impairment loss of 584, but it's going to be reversed, so we record it as an addition. Then the balancing amount there, that's the opening balance of retained earnings. Hectic, right? A lot of calculations. So we need to make sure that we're comfortable, all right, with these calculations. Otherwise, the examiner will have a good time with us. So we need to make sure that we know our story there. All right? Please, guys, let's practice. Practice, practice, practice. Practice makes perfect. All right? Then we have our balance then. All right. I want you guys to work on this. So opening retained earnings balance. Right. Then on our next class, all right, we're going to finish this question where we do the calculation of the profit. But the concept of changes in ownership is going to come in as well and all those kind of things. I don't know if you guys did attempt this question. I know I gave it out some time ago and we've been busy with it. Not sure if you guys have attempted it, but please, guys, look at this question, all right? You can look at the one that we're doing now, or you can look at it, of course, after class. Still fun, but it's a very good question. So it integrates, it opens your mind. That's the stuff that you should expect in the final exam. So you need to make sure that we're comfortable with this. Right. Don't worry, Miss Kiddies, all right? Don't worry. If you, okay, look, whether you qualified with the 60 or you qualified with 40, still fine. The exam, look at it. Let me show you something. How it works, right? The exam counts what? 60%, right? Am I right? Or they changed this year? How much is the exam?
80, I think.
Is it 80?
I think it counts for 8.
80%.
How much?
80%.
80%. That's a
80.
30. 80.
80, yeah.
That's a lot, eh? You don't even need to worry about anything. Right, of course, I'm referring to the level 1, guys. I don't know about the level 2. Right, but think about it. If you get 55 divided by 100 times 80, right? You're sitting at 44. Do you know what that means? You're 44% with the exam. Now, let's see. You walked in with 40 out of 100 times 20. You have 8. See? So 44 plus 8 gives you how much? 52. In the exam, do you see how much do you need? Let me just show you. Let's say, for example, you got 53. 53 is just too much. Let's say 52. So in the exam, you just need 52. Miss Kiriza. All right? So regardless, so with your 44, actually you're 44. That means you don't even need 52. All right? How much do you need in the exam? Maybe let's say 50 or 51. So you need roughly around 51. Because if we add these two, so you're gonna need this plus this. Do you see 49.6? They'll push you to 50. So you need about 51% in the final exam to pass. So that's why I'm saying it doesn't matter what you're walking in with. What's going to determine whether you're going to make it or not is what you do from now until the exam. Don't forget about the semester mark that you have. You're not as bad as somebody who's walking in with a 60. Because someone who's walking in with a 60, right? Look at it. Someone who's walking in with a 60, they're sitting here. They have 12. You have 8. This person needs how much? They need roughly around maybe 48 or 46. Let's say 46. Right? They need not 46, they need about 48. So this person needs 48. You need 51. You see, there's a slight difference between the two of you. So don't stress about that. All you just have to do is to stay focused. From now, what do you do from now until the exam? That's going to differentiate. Never think to say, no, I failed because I had a lower DP. No, you failed because you didn't handle the exam properly. That's all. The qualification is just there to allow everyone an equal chance to make it. But otherwise, the DP is not going to change anything. Whether you have 100 or you have a 40, you're not far from each other. Right. Anything else, guys, before we close?
Nothing in. Just this is hectic.
Just have to push a little bit, right? All we need is just
Yeah.
push a little bit. But as I'm saying, you can see in terms of this, that's something that's quite hectic. It's different from what we used to. Don't dwell on old tests. Focus on the new pack because that's what's going to determine whether you make it or not. Work on those questions properly. Understand what you're doing. They're hectic, true. But if you practice more, you realize that your body will just adjust, all right? In terms of this, it will adjust slowly, slowly until you make it. Right. Have a wonderful evening. I'll see you guys next week. All right. Just note there's one paper that will be a bit harder than the other. The other one will be better. All right. It can be morning or afternoon session. One paper will be better. The other one will be a bit hectic. So what's important is when they bring a lighter paper, you need to maximize there. All right. So if I can say maybe this case study was the harder one, the other one was a bit easier. All right. So it's just a balance. Bye, guys.
Thank you, Sepe.
Bye.